I'm Charlotte McLeod with investingnews.com, and here today with me is Scott Melbye. He's Executive Vice President at Uranium Energy, the CEO, President, and Director at Uranium Royalty, and President of the Uranium Producers of America. Thank you so much for joining me. Great to have you here.
Charlotte, it's great to be here and talk about uranium at such an exciting time in our industry, and with nuclear power more broadly becoming more widely adopted and accepted. These are good times in the uranium space.
Yes, I think it's the perfect time to be talking about uranium. Really good to have you here. And we're actually we're catching up after a little bit of time. I think the last time we spoke was back in mid-2022. So certainly a lot has changed since then. And I thought we could start with the basics. At what point are we in the cycle for uranium right now?
Yeah, it's very interesting because we've seen uranium move over the last 13 months from basically $50 to over $100 a pound. It's now pulled back a little bit to around 95. But immediately, the analogy is sort of, is this another lithium? It's moved too fast, too high. Obviously, it's at a peak, it's going to come down. We couldn't disagree more with that, because the fundamentals behind the uranium supply and demand, the demand for nuclear power, which is driving the need for uranium and new mine production, couldn't be more different than where lithium is today. So we're still very much in the first or second inning of what is going to be a historic bull market. Again, we've gone through previous bull markets. Everyone kind of points to the 2004 to 2007 and really through 2010 were exciting times in uranium space. But the fundamentals today are far more, the fundamentals are deeper, stronger, and the story has more legs under it today than it ever has.
Yeah, and you were telling me before we began this interview, there's kind of three main buckets that you would look at when we're seeing where the uranium market is today. So maybe we go over those basics.
And really, what's driven uranium prices to go to where they are, and really the thesis behind uranium more broadly, are three things. Clearly the green energy transition and where nuclear fits in that's been profound. I just returned from COP28 in Dubai, where the climate change industry, if you want to call that, didn't even want to have anything to do with nuclear 5 or 6 years ago. And now we're center stage with 128 countries pledging to triple nuclear power by 2050. Another 150 companies, which our two companies were part of the pledge, to make that happen on the industry side. That's really something. And so it's not surprising we have 96 reactors have come online around the world in the last 10 years, 92 more under construction, and now we're just beginning to have the small modular advanced reactors. The second point is really geopolitics. And, after the breakup of the Soviet Union, we really opened the Western nuclear fuel industry to the Russians. And now we can't run away fast enough with Russia-Ukraine. And that's really gotten the attention of governments, particularly the United States. There's legislation that is promoting not just the growth and revitalization of the domestic uranium fuel cycle in the U.S., but to make sure that it happens quickly. And then the last is just how you would measure any commodity is supply and demand, production, demand, inventories. We're in a structural deficit today of around 50 million pounds between production and consumption. We've been in that situation for a long time. That's not new. But what is new is in the past, we always had a buffer of inventories and secondary supplies, which it didn't matter if a producer missed production guidance because the inventories were there to moderate a price increase. Now with that gone, if it's Cameco, it's Kazatomprom, it's any producer issuing their past year guidance and their outlook, or their past year production actuals and their guidance for the coming year, that actually has an impact on the spot price. More importantly, we need 8 to 10 new mines beyond the Kazakhs and the Russians and those big first-tier mines coming online between now and 2030. And the timeline of them coming into production and the rate at which they produce at now has critical importance, because we need those pounds.
Okay, I think that's a really good way to set up the market so we all understand what's going on. A number of follow-ups there, and I think maybe the first place to start, because I think you're probably very well positioned to talk about this, is this potential U.S. ban on Russian uranium imports and what's going on there.
It's very timely. Literally, I'm checking my phone for updates, but I think the incredible bipartisan support for nuclear power that we've seen in the United States, I lobby on Capitol Hill, and I've been in front of various Republican and Democrat administrations. I've never seen this situation where Democrats are trying to outdo the Republicans as to who loves nuclear power more. And we just like it because it doesn't matter, with a change of the U.S. president in 2024, it doesn't matter whether a Republican or Democrat gets elected for our industry. We're bipartisan supported. So we are seeing legislation pass, like the Nuclear Fuel Security Act passed and signed into law at the end of the year. The funding for that, the appropriations that would expand the strategic uranium reserve to include enriched uranium in the U.S., that's currently in the budget discussions, which are very contentious over things like Ukraine, Israel, border funding, but it's not the uranium issues. The House has it in their budget. The Senate has it in theirs. So if we can carve that off in an energy and water bill, which is what's being attempted over the weekend, to get that passed, that would provide up to $2.7 billion for this initiative. It also has a very clear tie that funding will not be made available unless a legislative or administrative ban on Russian uranium is passed. That also has unanimous support, if not for Ted Cruz, again, right before Christmas, holding up the passage, not because he loves Russia and hates uranium, particularly Texas uranium. He should be very keen to that issue. He's holding it up on another unrelated issue on semiconductor chip permitting and licensing. So it's not if, it's really when. We could see real developments this week with the passage of the Nuclear Fuel Security Act funding. So it's time that we develop Western uranium sources for Western needs. It doesn't all have to come from the United States, but the U.S. can't be producing zero uranium in an industry that consumes 50 million pounds a year.
Wow. Okay. So very timely. And maybe by the time we'll obviously try to post this interview as soon as we can, but maybe by the time it's up, we'll have an answer there. So that would be exciting. The other thing, I'm glad you brought up what's going on with the price right away and kind of getting that out of the way, because I know that some people are looking at what's going on and they feel a little bit worried. I don't even really want to call it a pullback, though. It feels more like a consolidation or a pause. So maybe you can talk about more thoughts on the price and where it could go.
Yeah. So a move from 50 to 100, it is a profound move in any commodity. In a more efficient commodity, let's just take copper. If you had a doubling of the copper price, you would have a production response almost immediately with standby mines in South America, Africa, and elsewhere. We really don't have that. So we can't lose sight of the fact that, yes, we assume Cameco is going to produce at full production from MacArthur and Scar Lake. Yes, the Kazakhs are going to produce at 55, 60 million pounds a year. We still need 8 to 10 mines coming online. We have visibility to a number of those in Australia, Africa, and a number in the U.S., which I'm really excited about. But those need to come online, and the new mines beyond the sort of low-hanging fruit still need to be permitted, licensed, built, and come into production. So I think there's nothing to keep uranium from going to $150, $200 a pound in this kind of environment. Now, is that the long-term equilibrium price for uranium? No. But we've never been at that magical, theoretical cross in the graph where those things intersect, but we're either way below or way above. But I think even when the price pulls back to a more of a long-term clearing price, it's not $50, $60 like we saw in the past. Inflation of new mines, especially big billion-dollar mines that need to be built, inflation and capex is a real issue. So I think, again, it'll be several years before we get the production needed to really moderate this. Now, for the utilities, I don't think it kills the golden goose. Uranium demand is inelastic. They need to have it for nuclear power plants. They're running 24/7. It is 5 to 10% of their generating costs, so it will have no impact, but it will not impact the competitiveness of electricity from nuclear power like you would have with natural gas, which is so fuel cost dependent.
Okay, and price, I was going to use this as my segue into what's going on with uranium energy right now, because we've been hearing for years we need the right price to have operations come back online, and just in January, the company announced some production will come back online. So I'm sure there's more than price that went into that decision. So can you talk about
Well, we said that with our production costs in Texas and Wyoming at around $40 all-in cost, we really are in the lower end of the production cost curve globally. But still, we said we wanted to see sustainable prices above $60 a pound. Well, we blew through 60 to 100. So now, the focus is clearly getting our mines back into operation. And so our first mover is Irigaray Christensen Ranch in Wyoming, which we announced the startup of operations in August, and obviously be ramping that up. At the same time, by probably second half of next year, we'll bring Burke Hollow in South Texas into production. The advantage we have existing infrastructure. We have central processing plant facilities in both states that serve as the mill, if you will, for our ISR operations, and even have extensive satellite well field, delineated well fields, obviously permitted and licensed well fields that can come on quite quickly. So it always has been a economic decision. Now at Uranium Energy Corp, it's what can we do to produce more over this time? I don't think we can move the timeline of August any sooner, but obviously we'll look with additional resources, drilling, what have you, to produce more faster is the motto now.
Okay, and with operations coming back online, sounds like it's going smoothly. How has it been in terms of finding personnel? Because this is a market that's coming out of some pretty tough times.
Yeah, it's a very real issue. I think one of the advantages that we've had, particularly in the staffing up that we've been doing in Wyoming, obviously we have key uranium people that we got with the acquisition of Uranium One. So we have the people that operated those facilities right up to 2018. So we have core people in Wyoming, in Texas, and at the corporate level that have the experience. But getting the people on the ground, the wellfield operators, operating control room operators, things like that, we are pulling from other industries in Wyoming, like the coal industry, like oil and gas. In situ mining is probably more in common with oil and gas development than it has open pit mining. But even folks coming from the coal mines who have worked in plants and those kind of environments. Now we have to get them trained up to uranium operational culture, including safety culture. So if anything, that is the critical path that's keeping us producing sooner than August. It's just making sure these new hires are fully able to go into production. We probably still have another 10 open positions that we're hiring as we speak, and then probably another 10 to 20 as we're starting up and we're expanding and incrementally adding additional well fields and growing from probably 500,000 pounds of production in the first year, but ramping up to 1 million, 2 million pounds at each operation. And eventually targeting 5 to 6 million pounds by the end of the decade between the two.
Very, very good. The other thing I wanted to bring up related to production. So as I understand, the output right now, currently 100% unhedged. So I wondered if you could talk about that strategy, what it means, if that's likely to change.
Yeah, so we're very unusual in that regard. And I have the benefit of having been, in the business of buying and selling uranium for the last 40 years. So I've worked with companies that are fully hedged. I mean, I managed Cameco's global uranium activities. For 23 years, I was in the marketing group there. So I get the pros and cons to hedging and not hedging. For a company our size with our production, both scalable with ISR that can adjust to real-time market conditions, very hard to, $1.5, $2 billion underground mine, you kind of set a mine path in place, hard to vary from it. So we can afford to be unhedged. We want to have 100% of our sales marked to the prevailing spot price. Now, that doesn't mean we just mindlessly dump uranium in the spot market. We're very savvy and are utilizing relationships with utilities, producers, traders, and even, the financial players like Sprott to achieve the highest price possible for our shareholder. Our job is not to hedge the upside price risk of the utilities. That's their job. Ours is to get the investor, 100% exposure. And I think it's very important because where we are in the cycle, we're not selling primary produced production into an oversupplied market. It's undersupplied, and the market needs those pounds. So we're confident that our production levels of 1 to 2 million a year going to 5 to 6 are not something that will be a negative impact on the price in any way. And more importantly, I think we'll have one of the highest average selling prices of any producer.
I wonder, on that note, if you can weigh in a little bit on how utilities are feeling right now, because I imagine they would like to sign long-term deals.
Yeah, they're coming to us and wanting contracts with us, and we're very willing to work with them. And we've even signed an agreement with a utility that's an agreement to sell to them at the prevailing spot price at the time of delivery, with no floor, no ceiling. So we're willing to have those utility relationships, but just, we're opposite from the other producers that are coming to them saying, I need a 10-year contract or I'm not going into production. We're the opposite. We don't want to be locked into prices. If we would have signed contracts anytime over the last 5 years, we would have legacy contracts that are well below the prevailing spot price today.
Right, and certainly you can see that in some cases.
But they're very eager. It's a game of musical chairs right now where the chairs are available mine production, and now that they're contracting at higher levels, these existing mines and even this next generation of new mines that are being built are getting very heavily committed. And so it puts pressure on the new additional mines to be built on time, on budget, and get into production, because those pounds are now not just extra to the market, they're needed to the market. And the utilities are very keen to see that happen.
Well, and how doable is that to get there, especially on time right now? It seems like it's a little bit trickier than people.
Yeah, I mean, anytime you start up a new operation, it's difficult. If you're going into a greenfield area where you're going into a new area, it's a little more challenging. I think you've seen success in the U.S. industry because a number of these mines, like UEC's mines, are restart of existing mines. So they operated right up to 2018. We've tested everything over the course of last year to ensure that we haven't lost anything in the well field in terms of pumps, valves, control systems. So we're quite confident, in a restart. But I mean, if you're talking about new mines with geopolitical developments, Kazakhstan is a big one. I mean, I think the West was really counting on a lot of pounds coming from the world's largest uranium producer. Well, China and Russia have other ideas, and they're very quickly consolidating what will be, largely 80, 90, 100% of Kazakh production in the future will be going to China and Russia. That's good for them. That's good for the global balance, but it doesn't help utilities in Europe, UK, Canada, the United States. So we need Western money.
Right. Yes, that's what I was alluding to. So thank you for going in that direction. So we've talked a lot about what's going on with uranium energy because there's so many developments there to cover, but we should go into uranium royalty as well and just maybe tell us about the strategy right now. Would you be looking to add to that royalty portfolio?
That's job number one for us. And, when we launched in December of 2019, we were still in a uranium industry that was coming out of a very, historic bear market. But the fact that we launched when we did and we're now fully, funded and operational, this is the perfect time for us because we're a capital provider for mine developers, for that cohort of companies like UEC, but elsewhere around the world in Africa, Australia, Canada, and the U.S. that need capital development to get into production. We come alongside, provide $20, $50, even $100 million upfront in exchange for a royalty or a stream, and help them bring their mine into production. We compete with debt and equity, but we've, especially with prices where they are today in the uranium market, we found that we can be, the low cost of capital competitor to those more traditional ways of finance. I know in base and precious metals, this source of mine development finance has become mainstream. It's still relatively new to uranium, so we're educating, but we're also getting out on the road. We're traveling to Australia, and we need to get to Africa and meet with all the producers in those regions to see how we can help fill that gap of new mines that are needed by 2030 and beyond.
And there is also, I believe, a physical uranium element to the company. Maybe you could go into...
Yeah, so between both UEC and Uranium Royalty, we've purchased close to 10 million pounds over the last 3.5 years. We've sold about 5 million of that, but the company still have a nice inventory of physical uranium. In URC's case, is held at Cameco's facility in Ontario. It's about 2.5 million pounds today. We're adding to that portfolio. Why? Because until our mines start getting into steady state cash flow, which really has just begun in the last year, like McArthur River, Scar Lake, Lance Peninsula, and Langer Heinrich are our earliest movers in the portfolio. But we wanted early shareholders to be exposed to the uranium commodity through physical purchases off the bottom. And I think URC eventually will turn that uranium into royalties. It's kind of our war chest for investment in royalties and streams. At UEC, I think, probably their focus now is more on producing pounds than purchasing. It's a lot better to produce a pound for $40 than to buy it at $100.
Okay, makes sense. Thank you for going into that. And we've covered a whole lot here, but we're gonna wrap it up. And I wondered if you had any final words for uranium investors heading into the year. I think they're generally pretty savvy, but things you think they should know.
Well, I'm happy for the uranium investors, whether they're the long-term sort of bull market investors of uranium that they've hung in there through thick or thin, or the number of both retail and institutional investors that have come into our space, looking at the same sort of fundamentals that we've just talked about and coming in for the first time. I'm really excited because I think generational wealth is going to be achieved by investors in the uranium space. And again, this is a early stage of something that's going to develop over decades now, not months or even a couple of years. So just excited for the perseverance and patience that the investors did show during the downturns. And now it's time to really realize those gains. It's an exciting time.
Yeah, let me tell you, it's very nice to be actually having some positive uranium interviews. So really good to have you. We'll check back in with you hopefully soon. And once again, I'm Charlotte McLeod with investingnews.com, and this is Scott Melbye with Uranium Energy and Uranium Royalty.